All right, let's talk about today's topic. Today is Wednesday, November 20th, and the topic of today is I hate to say I told you so. No, really, but let's take a look at the market. There's a lot to talk about and the market's really starting to descend. What's interesting is when the S&P opened lower today, the Russell 2000 was actually rising, and then it started falling again as well. But the S&P starting to move down. The whole anticipation or the excitement about resolving the trade war has fizzled out, as it has many times, and as I told you it would. It just takes a matter of days. The Fed has told us we are not lowering rates anymore this year. The kitchen is closed. No more soup for you. We're done. So that leaves us vulnerable. And now the China, U.S., we're not any closer right now than we were a year ago to settling our differences. So there's really no resolution right now. And because of that, I believe it's the best time for you to start looking at defensive assets, at least till the S&P hits the 200-day moving average. I don't know if we're going to go all the way down to the 200-day moving average. I think there's a good chance we'll go somewhere in between the 50-day and the 200-day. Let me put that up here so you'll see what I'm talking about. But here you can see both of them. So I believe we'll go below 3,019 and settle somewhere right around the 2960, 2970 level. That will give us a nice little uptrend, and it'll release a lot of the pressure that the market has been seeing, which has been causing volume to be literally about 30 to 40% what it was in August. Now, imagine August, the slowest month. Everyone's on vacation in August. Volume right now is a third of what it was in August. So this really is eye-opening because it's telling us institutions are staying out. How do we know it's institution, not retail clients? Well, institutions account for about 80% of all money on Wall Street. And the volume is down from 170 million shares on the S&P to about 40 million shares. I can assure you that's not me, my grandmother, or my aunt and cousin doing these trades. It's massive volume. From 140 or 170 million down to 40 million. That's huge. So what are the choices? What can you do now? Well, choice one is you could stay out of the market or lower your exposure, lower your position till we hit the 50 or possibly go a little lower than the 50-day moving average. We're still overbought. We're just now getting some of that pressure released, and it'll take at least a week or two to see the bottom here, possibly even more. We may see the 200-day before New Year's, all right? So what choices do you have? Well, one, let's say you want to be an aggressive investor right now. This is the inverse S&P 500. This literally is like trading the S&P 500 inside out, if not inside out, upside down, if you don't want to trade short. Some of you say, hey, it's no problem. I'll just take the SPY, which is right here, and I'll just short it, right? Well, a lot of you don't like to short the SPY. A lot of you are in IRA accounts that don't allow you to trade SPY. I get it. They don't allow you to short SPY. Everybody allows you to trade SPY. And SPY is the most liquid ETF in the world, exchange traded fund. It's the S&P 500 in one stock. One bang, you get all 500 stocks. So it's really, really good way to get your bang for your buck. And this is what I was talking about, volume. Look at over here, 178 million, 54 million, 35 million. This is November, October. Volume should be a lot higher. So I'm expecting us to move down from break the 50-day, take out a lot of stop losses, move down to the 297. And if you're looking at the SPX instead of the SPY, just add a zero in the end. So instead of 296, it'll be 29,600. Now, again, if you don't like to short or if you're restricted from shorting, no problem. This is inverse of the SPY. For every point the SPY moves down, this moves a point up. For every point the SPY moves up, this moves a point down. It's a direct inverse asset of the SPY, ticker symbol SH. Let's say you completely want to eliminate the stock market from your life for the next few weeks, which may not be the worst idea. Not necessarily. It's still a good time to stock pick. We're still in a raging bull market. We're still going to make new highs, but it's going to take a little longer. there's the bond market. This is the TLT. We just took off a 112% profit on an option on this asset, and I believe it's got substantially more upside to go. I'm just waiting for a little pullback to the 50-day line once again. But aside from that, I believe the bond market is going to rally and hit about the 150, ticker symbol TLT. This tracks the 10, 20, 30-year bond. There's very little difference in movement between 10-year, 20-year, and 30-year bond. T-note or T-bond if you want to get really specific with me. But the bottom line is 10-year, 20-year, 30-year, it's called 20-year plus. This is the most liquid ETF that follows bonds, ticker symbol TLT. And another asset that you really want to look at right now that I believe is going to give you some upside is going to be gold, ticker symbol GLD, because gold has an inverse correlation with the U.S. stock market. And if China and U.S. don't resolve their differences, there's going to be a lot of investors shifting money from speculative assets like S&P 500 into fixed income and assets that are not correlated to the stock market like gold, okay? So that's what you need to pay attention to. If you insist on staying in the stock market, I get it. This is just a little tidal wave. It's nothing major. The stock market's not going bearish, not anytime soon. My suggestion is lower your exposure, wait for a pullback to the 50-day line, possibly lower, and wait for me to give you a green light. All right? Hope that helps. It's time to be nimble. Gang, like I said, you need to have different assets in your portfolio that are not correlated to the stock market because eventually the stock market will soften up. It's going to happen. Just trading stocks won't cut it going forward. And that's why I build a system that's designed to thrive no matter what the broad market does. I'll repeat that. It's designed to thrive no matter what the broad market does. It specifically trades assets that are not correlated with the market. And I'll guarantee you've never seen anything like it. Follow the link below. Get all the details. Now's the time to add this strategy to your toolbox. Do it now.